The wealthmanagement.com Advisor Innovations podcast is sponsored by LPL. As financial advice continues to evolve, LPL is at the forefront. Whether it's growing your RIA or building an independent practice, advisors can pick the business model, services, technology, and product mix that best meets their clients' needs. As a top wealth management firm 100% dedicated to advisor success, LPL looks forward to learning how they can help you build your tomorrow today. For information and show notes, go visit lpl.com/advisor innovation. Okay, hello everyone, and welcome to this edition of the Advisors Innovation Podcast, which, as you know, is my excuse to have informal but hopefully informative conversations with folks in the wealth management ecosystem who are moving the industry forward in new and interesting directions. And today we're talking to Anders Jones, the co-founder and CEO of Facet Wealth. Anders, thanks very much for joining us.
Thanks for having me. Excited to be here.
It's great. First, I think we've met a few times in the past, but I think the first time we met, was lunch somewhere in Midtown with some wealth management folks, probably around 2016, 2017. Your company had just launched. I think it was just the three or four of you in Baltimore, thinking about this new model for financial advice, new model for bringing clients in. At the time, as I recall, you had a business model that was a bit different from where you are now, as I understand it. But maybe you could just go back and give us a little bit of the origin story of Facet Wealth. How you started, and then we'll take it up from there and get to where you are today.
Absolutely. So I think as a starting point, just to kind of frame what we're building and what we see the vision of the future as, we really see an opportunity to rebuild financial planning the way that it should be. And in particular, focus on the 40 million or so households that broadly defined, people refer to them as the mass affluent market, of folks that don't that have more nuance and complexity in their financial life than what a purely digital or DIY solution can help with, but at the same time don't have the investable asset level that's interesting to a traditional advisor. And the origin story actually came in the wake of the DOL fiduciary rule failing. And if you recall, a big part of the pushback around that from the industry was, if you pass this, you're going to have 8 million households that lose their advisor relationship because the advisor can't afford to both service them and act in their best interest at the same time. And I know that the argument was a little more nuanced than that, but that was sort of the broad strokes, especially for someone like me who's an industry outsider, or I guess I was at the time. That was sort of the distillation of the argument. And so that was sort of a real light bulb moment. I was like, wow, here's a very sort of public admission that that there are existing clients that are not getting the best deal that they could, quote unquote, best execution from the existing sort of industry set. And there's probably a real opportunity to build a service that suits their needs. So that's what we set out to do. And you said our business models change. I would say our business model has actually always been the same. It's, we started out saying we're going to build subscription-based, human-led, tech-enabled financial planning that looks at every aspect of someone's financial life and offer it to folks that sort of don't meet the minimums of a traditional advisor. And that's what we've been doing from day one. I think what's changed for us is our go-to-market approach. When we started the company, we said, well, okay, there's a ready-made market of 8 million people who've opted into an advisor relationship and are not getting a good deal. And frankly, the industry doesn't really want to service them anyways. And so we can actually go and partner with other financial advisors and essentially buy part of their books and transition those clients that aren't a great fit for their service model over to Facet. That made a ton of sense on paper, but in reality, when it actually came time to execute on it, it was much harder to pull off. So about 3 years ago, we made the shift to a much more sort of direct to consumer focused model that is consistent with where we are today. And at this point, we're more than 10,000 clients, actually close to more than 11,000 clients, and we 10x the business in the last 2 years. So we're on a pretty great trajectory from a scale standpoint.
Yeah, it's a fantastic trajectory. I mean, the growth over the past couple of years has been amazing. And coming from if I have to say, from someone who was in the industry a little longer, there was some skepticism early on. I think when you guys first came around, I think some of the long legacy players in the industry were skeptical that this band of outsiders could could pull it off. And you say that your client acquisition strategy changed, your go-to-market strategy changed, and I get that. I understand. At the time, it seemed very innovative to go and to pick these clients off whom a traditional financial advisory firm was losing money on, essentially, right?
Yeah.
And I'm surprised to hear you say that didn't really work out, because you're right. On paper, it does make a lot of sense. What was the roadblock there?
I think the challenge was you'd have there are a few things. One is the level of sophistication with financial advisors, just in sort of understanding the P&Ls of their own businesses, varies widely. You have some that are very sophisticated. You have some that we literally had to sit there and explain, this is what gross margin is.
Well, probably more in the latter camp than in the former camp.
I won't comment on that.
I'll take
there that. There you go. So there's a sort of wide range of sophistication. And so sort of explaining the economic and financial logic, that was actually a lot harder. There's much more of an education component there than we had originally anticipated. I think, the other thing is, if you're an outsider looking in, you read sort of the press around a very active M&A market. And so we figured, oh, okay, this is great. We're walking into a very liquid market of buying and selling of books of businesses. It should be pretty easy to, carve out a niche of sort of buying the sort of smaller set of clients. What I didn't realize is that
book. Yeah,
exactly. Yeah. What I didn't realize is that, yes, there's a large number of transactions, but those transactions sometimes take 5 years to actually put together. So the market is not nearly as liquid as it appears. And then the last piece, I think, is that when it actually came time for an advisor who said, yeah, I'm going to do this, when it actually came time for them to pick up the phone and call a client that they'd worked with for the last 10 years and say, hey, I'm not going to work with you anymore, and by the way, meet Facet, that was probably the biggest roadblock. That, we actually signed up a lot of advisors to kind of do the partnership. But then when the sort of rubber met the road and they actually had to transition the clients over, that was a hard thing for a lot of folks to do. And I think that actually speaks well to the advisor community, because they had developed real relationships with these folks, and even though it wasn't the economically rational thing to do, they wanted to keep helping them.
Yeah, and I think there was a perception that this is just going to be an advisor trying to dump off the low end of their book onto a robo, and we'd seen some other technology companies try to come in and go to an RIA space and take over that role, right? Be the robo inside that, help service the lower end clients. I hate that word, but for lack of a better word, lower end client in a more efficient way. So you switched strategies, went to just a consumer based strategy, and that seemed to work. That seemed to take off, and that's the toughest thing to do in this industry, right? A client acquisition, no matter if you're a robo or a human advisor, whatever you are, the client acquisition strategy is the toughest one for advisory firms to handle. How did you do it?
Well, I think it starts with the fact that we're going after a market that no one else wants to service. I said that, we're at 11,000 clients at this point. 75% of our clients, actually more than that, have never worked with an advisor before. So I think that there's a lot of the sort of existing advisor base really goes after a lot of the same clients. And so it's very, very competitive, especially when you're targeting sort of the $1 million plus market. It's incredibly competitive there. We're going after folks. Only about 50% of our clients actually have investable assets. That sort of automatically disqualifies the other 50% for working with basically anyone else. And at the same time, I'll give you a sort of a sample profile of one of those clients. Is someone who just graduated from law school, maybe making mid six figures, has $70,000 of student debt, no real savings. They certainly have the capability to pay our annual planning fee. And we can do a ton for them to help get them set up, help them think about, sort of entering the workforce, starting a family, putting some roots down, whatever it might be. And, we can provide real value there, but there isn't really anyone else that they can work with and do that. So I share that because really for us, we're going after a relatively blue ocean opportunity. And it's interesting because, there's a lot of discussion in the industry about, this is the sort of untapped market that everyone is trying to crack the code on, and no one has figured out how to do it. And it's so funny to me, just the huge resistance to the subscription model or moving away from the AUM-based model is the thing that's holding people back from servicing these folks. And I think as soon as people are more comfortable with a subscription-based or flat fee model that's not tied to assets, all of a sudden there's just a whole world of opportunity there that that could be unlocked by existing players, but no one is really willing to take that plunge.
Well, I'm going to push back on that in just a little bit, because I do think that there are plenty of younger financial advisors in the RIA space who are going down that road, right? I mean, we see the subscription models, subscription for planning, recurring fee-based, whether it's a flat fee or a monthly fee or a retainer fee, whatever it is. Those models are in ascendance, right? There are more people taking up that challenge. But here's where I think the problem is: it's really hard to do that efficiently. So if you're one advisor and you are charging a subscription-based fee, you're capped on the number of clients you can have and work with effectively if you're doing a good job in a true planning model, true planning for them. You guys seem to have solved that riddle or are trying to, or have made some great strides to it. Talk to me a little bit about how many advisors you have, how efficient they are, how many clients they can service under this subscription model.
I think that's a fair point. I think that there's a sort of a flywheel that kind of all has to work together, and the subscription fees are certainly a part of it, and how we charge is part of it. The other big component is our focus on cost reduction. And I think that, from the beginning, we sort of looked at the landscape of financial technology and wealth tech and sort of where the focus was on what was being pitched to advisors. And there's not a lot of discussion around how do we make you more efficient? How do we decrease your cost of service? It is much more focused around product distribution and, other, better ways of managing money and that sort of thing. But
more service, right? More offers.
Exactly. And so I think that, actually looking at, the very unsexy administrative workflows that actually take up a huge amount of advisor time, how do you automate those away? That's where we started. Some interesting stats, and I'm sure, different advisors will have different numbers here, but on average, an advisor will spend about 3 hours of prep and wrap up time for every hour of client facing time. And so you think about, only 25% of their time is actually utilized in their highest and best use, which is time in front of the client. And the rest of it is very low value added work. Things like going into a bunch of different systems and pulling data and building reports and doing a bunch of stuff that is actually, when you sort of put your mind to it, very easy to automate. But, the vast majority of financial advisors are not software developers. And so, the idea of sort of putting together a system that can automate a lot of that, even if you strung together the best in class wealth tech products that are out there, very difficult to do. And so we approach it from a position of, we want 100% of our advisor time to be client facing, and anything that's not human to human contact, we should figure out how to automate. And that's really where we've focused the vast majority of our tech resources. So you asked about some sort of efficiency metrics. Again, sort of industry average, roughly 75 clients per advisor. When ours are fully ramped, they're in the 220 to 250 range. So, so almost 4 times as productive. And, for us, kind of the prep and wrap up is 5 to 10 minutes. And there's no quality degradation there. It's really just, we've gotten rid of a bunch of the super low value added stuff. We've put all of their workflows into one centralized platform, and everything from communication to actually building the financial plan to scheduling, whatever it might be, it all sort of lives within one place in our platform. So that's been sort of the other side of the coin that's allowed us to service this market. So
you make it much more easier for your advisors to run their sort of day-to-day life. Another thing that you take away from the advisor is the getting clients, right?
Yeah.
What I understand from your model, you don't. The advisors themselves aren't out there beating the husks trying to get referrals and prospect.
That's right. So again, we think the advisor's highest and best use is time serving the client, not selling the client. So there's certainly an efficiency component there. I think there's also a sort of positioning with the client piece there as well, which is, we are going to be the client's unconflicted and fully transparent resource, right? We're never going to set ourselves up where we're making money off of a commission or any sort of product sale. the only thing that our advisors get comped on in a variable sense is client satisfaction and retention. So we're really setting it up so that we can be, sort of as pure as possible in our client relationship. But yeah, we have a separate team of folks that qualifies leads as they come in. I mean, at this point, we're doing a ton of digital marketing, sort of everything you would expect to see in sort of a growing direct-to-consumer digital brand, search, social, affiliates, paid media, all that stuff. We're probably getting, 2,000 to 3,000 leads a day at this point. And we have a team of 50 or 60 folks that are qualifying those and putting them through a pretty rigorous sales process to, make sure that they're the right fit for us and we're the right fit for them. And they have the, that we're really onboarding the right clients and matching them with the right advisors. But the end result of that is that, the advisors don't have to sell.
And I mean, I bump up against Facet Wealth digital ads quite frequently, honestly. So I know you're out there.
Are you a client? Are we just wasting spend on you right now?
No. I'm the wide part of the funnel, How many advisors do you have right now?
We're at, I believe, 104.
Okay.
Yeah.
Where are you finding your advisors? This is kind of interesting. I remember back when you probably take some umbrage at this, but when Personal Capital was kind of doing, I guess, something kind of similar. I don't know. Maybe you can describe maybe how you differentiate yourself from some of the other robos with an advisor in the background. But I remember Personal Capital, they were quite happy to kind of talk about their advisors and they were all CFPs and where are you finding your advisors? And these are all W-2 employees.
Yep. All W-2 employees, all CFPs as well. I would say the biggest source for us are places like Vanguard, Schwab, Fidelity, hiring out of the call centers. These are folks that have studied for 3 years to get their certification, have the skills and ability to do sort of the full range of financial planning and are basically stuck answering an 800 number, doing asset allocation and what I would describe as sort of retirement planning light. Mm-hmm. And so, our value prop to them is, hey, come and work and really help people in a much deeper and broader way than what you do now. And also you get to build your own book of clients. So you'll have a set of client relationships that you'll keep as opposed to sort of being on the other end of an 800 number. I think as we look out in the future and think about sort of, where are we going to continue to grow our advisor base from, some of the things that I get really excited about are building direct lines into undergraduate programs and, really kind of tapping into the sort of up and coming advisors in the industry and offering them opportunities early on so we can sort of steep them in the Facet way of doing things.
Yeah, that's interesting. Have you guys considered at all, and you don't have to answer this, but is there a process that you've built or a platform that you've built that could easily be white labeled and licensed out to other advisory firms?
We get asked that all the time. And I think the answer is no. Mm-hmm. And there's two reasons. One is practical, which is that building a services business or a sort of consumer facing business, which is what we are, versus building a SaaS business are two very, very different propositions. For us right now, if something breaks internally, we have 100 people who are mildly inconvenienced, but we can typically get it fixed in an hour or two. And life goes on. If we started selling software to advisors and all of a sudden something broke, there's a whole other set of issues that you open up around support and SLAs and how are you going to kind of manage that, and it builds a totally different culture and a totally different cost structure than what we're set up for now. I think more philosophically is that as we sort of think about how would advisors use our platform, chances are they would basically use it to make more margin on high net worth clients. It probably wouldn't sort of achieve the mission that we really set out to do, which is to really open up access and do financial planning in a different way for a huge part of the market that really needs it and doesn't have access to great options. Yeah,
no, that makes sense. So recently, $100 million equity raise. That's great. Congratulations.
Thank you. Yeah,
that shows a lot of confidence, I think, from investors. What do you plan to do with the money? And I guess this question is sort of around, what your future growth plans are. I think you spoke to one of our reporters and said, you weren't necessarily going to use the money to buy or to hire more advisors and grow that way. Mm-hmm. You had other plans.
The number one answer is growth from a from a customer perspective. We will likely double again this year from a client standpoint, and we'll probably do it without really hiring any net new advisors, would be my guess. This is going to be a great year of us sort of fully realizing some of the efficiencies that we've created, that we made possible with the tech that we've built over the last couple of years. So that's exciting to kind of see it come to fruition at scale. So I'd say, bucket number one just goes to customer acquisition and growth. Like I said, we see it as a 40 million household market. We have 11,000 clients. We have a long ways to go. So there's always going to be room for more growth. And then the second is thinking about what does the consumer experience and the client experience look like we can build and, really continue to differentiate. So I'll give you an example. Last year, we launched tax and estate planning as two sort of additional services that we offer to our client base. So, for $750 a year, we'll do your taxes and we'll do an annual estate plan review. And that includes getting you set up with an estate plan if you don't already have one.
Will that also include the legal documents as well? Will you?
Yeah. Yep. And we have estate planning attorneys on staff now. And so, we do everything up to the point where you have to go get it notarized. And so, we offer that to a subset of our client base and had a tremendous uptake rate on that. So we've got now a couple thousand estate plans and tax returns that we're working on. And we're going to learn a ton about how to do that well, both from an efficiency standpoint, but more importantly, from how do we provide a great experience to our clients. And so I think for us, figuring out, okay, we're doing it very manually right now. How do we build that into a much more automated and integrated experience in our tech platform, not just for our team, but for our clients as well. So it's almost this idea of like a digital family office for our clients, which, again, sort of going down the sort of development path that got us where we are now is we'll do it all manually first, which is what we're doing right now. And then in the next 6 months, we'll have a much clearer idea of what the roadmap needs to look like to support that from an automated standpoint.
It strikes me that you might also then, and I know estate planning is not purely the purview of the high net worth client. There's lots of reasons why mass affluent might use an estate plan. However, it strikes me that maybe you are thinking about going up the net worth ladder perhaps a little bit. And why not, right? I mean, there's no reason why a high net worth client is not also interested in a subscription-based plan more so than AUM-based investment man, and no reason why technology doesn't help serve them as efficiently as the mass affluent.
That is true for sure. I think I would point back to the sort of the crowding of the market in the high net worth space. That it's going to be harder and harder to differentiate up there. I think what's more interesting to us is, our lowest annual fee right now is $1,800 a year. And so what can we build for $500 a year? Or what could we build as a one-off $150 offering for someone who is about to get married and just wants to get a quick gut check on the financial implications of getting married or of having a kid? So I think to the extent that you see us expanding our market, I think you're going to see us look sort of farther down market than up market.
Interesting. Okay. In that direction, who do you see as competitors then? Your Vanguards, your Schwabs, Fidelity. I mean, they also are rolling out planning. They do have call center advisors, which they would probably bristle a bit to calling them call center advisors, but yes, that's what they are. Where do you see competition on your expansion plans?
So I actually would look more towards pure technology companies. So like the Mints or the Truebills or the Credit Karmas of the world. I think that those are the companies that in their current iterations have tried to build pure technology consumer products. And it's hard. I mean, there's so much nuance and complexity in like real financial planning. And if you're really getting into the weeds of someone's financial lives, it's almost impossible to build a truly automated solution without any kind of human intervention. And so, so for us, I think, being tech first, but having a human in the background. And again, for the lower market, the lower cost products, it might be a very, very light human touch. But But, that I think is still going to be a critical component just to understand the nuance of what's going on in someone's life. I think we're a long way away from being able to truly automate all of it.
Yeah. You say that you don't manage assets, or you only 50% of your clients are have no assets to manage, I guess, through you. What the 50% who are, what does that look like?
Yeah, so we do manage assets. We have more than $1 billion under management. Actually, ironically, we got there faster than any of the robos, the wealth fronts, the Betterments, the personal capitals of the world, and we've never put it sort of front and center as our value prop. But that to us is a very sort of low cost, globally diversified, passive indexing approach that's really focused more on market participation and cost reduction. We don't do any kind of active management. We are sort of exploring. There's a lot of interesting stuff happening in the asset management world. I mean, crypto is obviously a big one that comes up. I think 54 million Americans own some version of a cryptocurrency. So that one's getting harder and harder to ignore, even if it's not going to become a central part of our asset management strategy. And then also kind of self-directed. We're getting, I think, increasing questions about when can we have a sort of brokerage offering through Facet. So so those are some of the things that are kind of coming down the pike. But for the time being, we keep it fairly simple and straightforward for our clients.
A basket of Vanguard ETFs, or
basically Vanguard, BlackRock.
Yeah. Intriguing about crypto. What would you look at there? Who would you look to partner with somebody there, or build something internally?
It's still such early days for us. I honestly don't even know. And that's not me being coy. We just haven't done the work. It's, our position on crypto right now is that if it's something that you are interested in, go for it. Our job is to make sure that the rest of your financial life is in order so that, if and when the volatility hits, you're not going to be left destitute. I think, sort of figuring out how to build that into some sort of offering as part of our portfolios will be an interesting exercise for us to go through. We did sort of laugh, as we went through this fundraising process that, if we had a crypto offering, even if we just said, yeah, we help our clients with crypto, our valuation would probably have been like 10x what, what it was. But
yeah, well, that's chasing the shiny object.
Yeah, exactly.
Well, anything else surprise you when you spoke to potential investors when you were making this last round? I mean, any questions that came up that either thought-provoking or questions that maybe led you to believe that folks don't really still get this industry as well as they should, or any surprises?
I think it's an interesting question. I think, it's always interesting to go through a fundraising process. And, this is the third sort of real round that we've done. And it's always a really interesting exercise to go through and understand what it is that the market is valuing at any moment in time. Mm-hmm. And, we sort of hit the market at an inflection point around, I think the last 2 years have been, or 2+ years have all been about growth basically at all costs. The faster you grow, it almost doesn't matter what the rest of your economics look like, just as long as you're showing top line growth. And I think, obviously the equity, the public markets have taken a bit of a hit in the last couple of months. And, I think the sort of feedback coming from that has been growth is now less important than having a, really capital efficient business. And so I think we're starting to see the world kind of turn in that direction. And, it certainly influenced some of our plans around how we're thinking about the upcoming year or 2 years. But yeah, it's always interesting to sort of put a foot in the market and see what's being valued, because it changes all the time. So that was sort of one sort of interesting observation and interesting to sort of, start the process in one paradigm and end it in another. And then, I think the other thing too is just there's sort of two sets of investors that are interested in the industry. There are those that are more what I would describe as like private equity, thinking about sort of the cash flow aspects of an RIA business with very sticky customers and healthy margins. And then there are those that are more disruptive, saying, okay, well, there's a sort of trend across industries of fragmented industries consolidating around one or two dominant digital players. And we're looking to back the sort of winner of that race. And so you get two very different perspectives when you talk to those two types of investors, and obviously two very different risk profiles and certainly two sets of things that are two sets of sort of operating criteria that, are quite different.
Can you characterize at all your trajectory with the most recent raise? I mean, is it an IPO eventually? Is it a sale to a larger company? What can you tell us?
So I think for us, the sale option is largely off the table at this point. The firm that led our round, this last round, is Durable Capital. They're primarily a public market investor. Henry Ellenbogen, the founder and chief investment officer there, came from T. Rowe Price, where he led their small cap growth, the New Horizons Fund, their small cap growth fund. Actually, funny coincidence. Like when I was in college, I actually interned for that fund, and it was before Henry managed it. So but it was just kind of funny how these things come full circle. But
small world.
In any event, so they do limited private market investing, but sort of with the with the thinking that the companies they invest in the private market will go public. So that's sort of the trajectory that we're on and how we see things going. Obviously, who knows what the future holds? You can never predict the future, sure. And so it's hard to say exactly when and how that will all take place. I've also heard that being a public company CEO is really not that much fun. So I'll probably try and prolong it as long as possible. But we'll see how it all shakes out. But I think the big takeaway is that we're very focused on becoming a generational company and being around for a long time and joining the ranks of the Fidelities and the Schwabs of the world. And so, so whatever our capital structure is at any given point in time, it's really going to be about supporting that longer term vision.
Well, that's fantastic. I've kept you longer than I intended to. Anders, thanks very much for your time. I really appreciate it. Congratulations on the equity raise, and keep up the good work. We'll be watching.
Thanks. It was great to reconnect.
And this is David Armstrong. You've been listening to the Advisor Innovations Podcast.
This podcast is sponsored by LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial is a separate entity from and not affiliated with wealthmanagement.com.